I know what you're thinking. You're asking yourself whether this little relief rally is over or whether it's the beginning of a bull market. I know that's exactly what you're asking yourself, whether this little relief rally is over. Why am I getting exactly what you're asking yourself? There we go. Switched off the echo. So that's what you're asking yourself. You're asking yourself whether this relief rally is the beginning of a relief rally, or beginning of a bull market, or the end of a relief rally, which has been going on for a while. That's the biggest question on everyone's minds. And today we're going to talk about that. And we're going to talk about it with probably the biggest lineup of guests we've had in a long time. We've got Kevin Leary, Raoul Pal, and Jurrien all here to answer your questions. We're also going to be talking about the ETH merge and the significance of the ETH merge. We're going to be talking about BlackRock. And then lastly, we're going to be talking about Tornado Cash and what's going on with Tornado Cash. So it's Friday. It's going to be one of our biggest banter shows. Let's do it. I see Mr. Wonderful in the back here. Let me tell you, he's smiling. He can't believe we played this song. But listen, we did do a poll before the show on the Crypto Banter Twitter. And we did ask you guys whether we should play this song. And 77% of you, when I looked last, said if we don't play the song, you're going to unsubscribe. So I'm going to let you unsubscribe. So here it is. We're playing the song for you guys. Alrighty. Big Friday Banter today. By the way, if you're not subscribed, now's a great time to subscribe. 94% of you are subscribed. 6% of you are not subscribed. That is up from, I think, we started off with like 40% of people unsubscribed. Now there's like 6% of you that are unsubscribed. So now's a great time. Hit the subscribe button. Remember, today we've got a massive show for you guys. We're going to be talking about this bounce and whether it's the beginning of a bull market or whether it's the end of a very aggressive relief rally. And let me tell you, I don't even think that our guests here agree about what's going on. We're going to be talking about Tornado Cash. We're going to be talking about BlackRock entering crypto and seem to be entering crypto in an aggressive way. And then we're going to be talking about the ETH merge and what our guests think about the ETH merge. So it's going to be a massive show. And remember that on Fridays, our banters are brought to you by NordVPN. If you're not using a VPN in crypto, first of all, you're crazy. But second of all, you can get one now. All you need to do is go to the referral link below. It costs about $3 a month, which, by the way, if you look at it in Korean won, because I'm in Korea right now, as you know, sounds like a lot. It's 4,512 won. But actually in dollars, it's only $3. And then you protect your IP address. You don't show people your IP address, which means you're actually surfing anonymously. And then exchanges don't know where you're from, protocols don't know where you're from, and people aren't collecting your data. And it makes it very hard for hackers to get hold of your crypto. And you've made it this far in the bear market. The last thing that you want to be doing is losing your crypto to a hack or something like that. All right, let's get on with the show. Let's look at the Bitcoin price before we start. 23,844. Nobody believes this rally. And I think Raoul was the one who said, I think it was Raoul, who said that this is one of the most hated rallies in equities, and then I guess in crypto, in a long time. Raoul, welcome, buddy.
Good to be here as ever, my friend.
So, one of the most hated rallies in equities, one of the most
hated... Yeah, it's super interesting. I run one of the many businesses I run is a fund-to-fund business in crypto, investing in digital asset hedge funds. We can see by the performance, most people are underweight. If you look at the equity market in technology stocks, the big players like Coatue, the biggest hedge funds in the world in technology, 75% cash. And then you see on crypto Twitter and FinTwit, people raging about the market going up. They're raging because everybody expects a leg to new lows. It's the story, and Jurrien will talk about it, about are earnings going to be taken down? And I've gone back through history. I think the probability is that even if we do have a recession, for some reason, the market's not going to make a new low, because I think once you take the inflation fear off, that helps a lot, because that's the big bogeyman. And the next one is rates. And as rates start coming down, that's the other big bogeyman. And that can really give things traction. And it's a very complicated story in corporate earnings right now, because nominal versus real earnings make things really confusing. So I just have a sense that I did a Twitter poll and 25,000 people answered. And I said, how many of you think there's a new leg lower? 70%. I said, how many of you are underweight? 75%. I'm like, okay, there's no way we can go back to the lows. Well, we could go back to the lows. I find it difficult to think we could break it, even though I think the economy goes down the toilet.
Oh, it's a great time to welcome our friend, Mr. Wonderful. Welcome back. And Jurrien, welcome back to the show. Jurrien, what do you think? Have we seen the lows? I mean, everybody hates this rally, except some of us that actually bought the rally. We've been telling our community to buy this rally for a long time. What do you think? Have we seen the lows?
If we avert a recession, which is a close call because kind of technically, we've had the 2 quarters of negative GDP growth, but certainly by the traditional NBER defined standards of a recession, we are very likely not in a recession, at least not yet. So if earnings survive, either because the economy does not implode or because inflation creates the illusion of nominal positive earnings growth, then I think the market has put in a solid bottom. We were down 25% at the low. You look historically going back 150 years, recession bear markets where earnings growth contracts tend to see a decline of 35% over 19 months, but non-recession bear markets like 1994 or 2018, 2011, other periods in history tend to go down only 22%. So we were down 25%, which means we priced in more than enough if it's a purely a valuation bear market, which is what we've had, right? The PEs are down over 30%, at least at the bottom. And that was completely rational and justified on the basis of rates rising, liquidity conditions tightening. We all know the story about inflation and the Fed. And at 25% of a drawdown, we priced in 70% of a recession scenario. So even if we do get a technical recession and we have an inventory cycle, but not mass layoffs and things like that, then you could argue that for a mild recession or a technical recession, we've priced in more than enough of a decline.
Jurrien,
yeah, go ahead.
Can I ask you a question? The two, because I've been thinking about our discussion about this recently. And the two that stand out to me that were similar in kind of inflation and limited bear markets was 82 and 1990. Those were both massive inflation peaks, but the market only came down 27% in 1982 and 20% in 1990.
Yep.
Have you thought about why those were different? Because they were both full recessions. ISM went down to 35.
Yeah, I think 1990 certainly bears some resemblance, and ironically, the bear market low at down 20%, as you mentioned, in October of 1990, happened after the NBER had declared the recession, starting, or it bottomed before that. So that certainly happens, on a regular basis. The early 80s, of course, was a massive inflation peak, but it also came after a 14-year secular bear market. So from that, and the PE was 7, right? So from that perspective, I think there are not that many similarities, but certainly the 1994 was, of course, a successful preemptive strike by the maestro, and he gave back some of those rate hikes in 1995. But for me, the bigger story is when we assume for a moment that the bottom is in, what's going to be the catalyst for the next bull market, right? Are we in a new bull market or not? And the problem is that, and actually, if we pull up slide 9, if you want to share that, the slide 9 in my deck. So go forward 9 slides.
You need to move your deck. You need to move your deck. I can see what you've put on the screen, sir.
Gotcha. Okay, hold on. So, the 2-year yield turned upside down has been a very good proxy for the PE ratio for the S&P 500, just like it was in 1994. And so what we're seeing is that, the market is pricing in peak Fed later this year at around 3.5. But the 2-year yield kind of is staying sticky at those levels because at least on the front end of the curve, it doesn't look like the 2-year is going to come down as much as, let's say, the back end of the curve. So with this rally, we're at 17.7 times forward earnings. There's a gap opening up there. So, bull markets can be led by valuation expansion or earnings expansion or the combination of both. And so I think if we are in a bull market, it's hard to make the valuation argument because the further we go, if it's not met by a lot of Fed easing, and of course we'd have to ask ourselves, if the Fed were to ease a lot, what would that mean for earnings? So if it's not led by valuation expansion, it just has to be earnings growth to carry today with stable valuations. And that is the recipe of a bull market. If earnings continue to grow high single digit or mid single digits, at least in nominal terms, and the PE stays where it is, you get a high single digit bull market, but it's not the kind of 20-30% increase that we tend to see off of the bottom. So for me, the bigger question is what what's going to be the story if this is a bull market to how to sustain it?
All right, well, I want to get to earnings, but before that, I want to go to Mr. Wonderful. Mr. Wonderful, what do you think, Kev? Do you think that we've seen the bottom or are we headed for another leg down?
I have a slightly different view of what is occurring here. I've lived through many cycles, obviously, as everybody has on this call. What I find intriguing about the nature of this correction, if you want to call it that, or the potential of a recession, is that it is in the foreshadow and then the shadow of $6 trillion worth of printing. And so you think about what occurred during the pandemic, which is unprecedented in any economy's history, to take that much and print it in basically 30 months and not to expect inflation. Well, of course, that's why we have what we have right now, a 40-year new high in inflation. But at the same time, if you could figure out the printing presses were going to stop, you would be forecasting a new leg up. And here's my thinking on this. There's two bills right now in front of Congress. And so one is a watered down version of Build Back Better. They're calling it anti-inflation, which everybody knows is a joke. This is very inflationary, but it's a spend over 10 years. So that's one attribute of more printing, which would maintain an inflationary stance and, of course, keep the Fed raising rates, which is not good for equities. And then there's this interesting situation in the chip bill where we're going to spend billions of dollars. It's, again, free money from a helicopter going into the Midwest to try and catch up with what's happened in our lack of ability to manufacture semiconductors. Now, cut it to what it is. It means that management, the Intels of the world, the AMDs, they made a mistake. They moved all their production offshore decades ago. Took the U.S. down from 32% of manufacturing down to less than 10. Now they got to bring it home. We're going to print money to make that happen. That also is inflationary. And you can sell it as something as a defense to the U.S., but basically you're supporting idiot management. That's basically what happened. You're picking a sector. Taxpayers are not getting anything from it other than just to give their tax dollars away to idiot management. And I don't mean disrespectfully, but there's management that can execute and foresees the future, and that's why they're good managers. And then there's idiot managers. So you could say many idiot managers guided manufacturing out. And why I bring this up towards determining the future of the market is every midterm election, and this starts in about 2 weeks, okay? It's November 8th, by midnight, November 8th. And this is my thinking as an equity participant. And I don't think a lot of people think this through. You've got a situation now where normally any incumbent, you don't have to get into politics, it doesn't matter. It doesn't matter what party's in power, they lose seats in the midterm. That happens 100% of the time. There's fatigue, people are tired, they want to make changes, and it's happening at a regional level. This time, though, in my view, there's at least a 50-50 chance that both the House and the Senate flip to the other party. I don't even want to get into politics, but the point is there's a lot of unhappy campers in America today based on inflation around food and energy. They're really pissed. And so when that happens, and it's so close, it's November 8th, this is the good news for investors. After that night, there will be total gridlock in Washington for the next 2 years. There will not be a single piece of legislation passed. It will be impossible to get anything done, and that's a great thing. That's a wonderful thing because markets love Washington gridlock. And I think whether you want to say it's PE expansion or earnings expansion, and it may be both, we're going to continue this leg up. Now, not 30%, but if you have an option between making 8 or 9%, including div distribution and yields on the S&P 500 at a 17 to 18 PE, or getting 2 to 3% on long duration treasuries, I think that's a no-brainer. You're going to stay long equities, and that's my position. I am underweight fixed income big time. I don't care when the Fed stops raising. That's another debate. Do they do 50 basis points? Do they 75? We're going to find that out. They may do 50. The narrative has changed to a soft landing for the first time in decades. Nobody gives credit to the Fed for ever delivering a soft landing because they never do. Maybe because of the backwater of all this printed cash, they have that opportunity to do this. So bottom line is, so I make it very clear, bottom is in. We're going to be flatlining for a while we wait to see what the Fed does. But if we get what I think is going to happen November 8th, Katie, bar the doors. Gridlock in Washington is a wonderful, wonderful thing.
Kevin, why is that? Why? Because I've noticed this in the past. As soon as there's a split Senate, House, all of this stuff, it's good for equities. Why? Because
take, for example, what's happening right now in this Build Back Better inflation bill. They're adding a 1% tax to stock buybacks. Why would you do that? Why would you do that? Then they put a 15% minimum corporate tax in the U.S., an idea floated by Yellen all around the world. Nobody followed her. Now the U.S. is less competitive. The politicians damage bull markets. They've never run businesses. They have no idea what they're doing. They're just throwing this stuff out there to raise money. I don't want to be a cynic, but it's a fact. They have no idea. And so they put these crazy policies in place. The more you keep chipping away with stupid policy, the more damage you do long term to your economy. Now, this 15% minimum tax does not help equities. It doesn't. It's just going to have companies contort and try and figure out how to get around it. Bottom line. The IRS, 88,000 more agents, that's just going to hassle small businesses in America. Not a good thing. So bad policy. The whole point is when you have a situation where Washington can move policy, more than 50% of it is bad policy. When you have total gridlock, they can't do anything. They can't damage anything. Listen, it's important to have government for many different services, but not for making economic policy. They're really bad at it. So that's why I point out, once you shut down the policy machine, markets get to move back up.
I can confirm, by the way, because I've done this study going back to 1850, I think, that a gridlock scenario of some sort is the most bullish outcome for the markets, primarily during the presidential elections, but also the midterms.
So we want both the House and the Senate to flip. That's what we're all investors are praying for now. That's what you're saying.
It doesn't matter. If you just get the House, you're good. But you might get both, in which case a new party gets to put more pro-business policy in place. You just don't know. But the chance that the status quo remains after midnight, November 8th, I think, is zero.
Also, if you've got gridlock, there's only one game in town. It's the Fed.
Okay, so let's pivot to the Fed. We had the inflation numbers this week. I think the inflation numbers for the first time in a long time actually shocked us down. I mean, the best estimate was 8.7%. We got 8.5%. I think most people were expecting 9%. The Fed doesn't meet in August. The next time that the Fed meets is after the September reading. In the interim, we've had one big inflation adjustment downwards. We have had oil prices down. We've had gas prices down. We've had commodities prices on the decline. Chances are that if you forecast forward to September, you're getting another 0.5% of inflation. Fed meets again with an inflation reading of around 8%. What do they do?
Yeah, so I think the big question for that, and actually we can pull up the slide here. It's interesting that the market expectations for the Fed's terminal rate, which is around 3.5, hasn't actually really changed that much since the CPI number, because I think the real story, like we all kind of knew that on a rate of change basis, the base effects would start to kick in. We all saw what's happened to the price of oil and copper and things like that. So this, it shouldn't surprise anyone. But when you look at the CPI math, right, the CPI is already up 6.8% year to date, and it's August. So it's even if the rate of change comes down, it's not going to come down that quickly. At the end of the year, we're probably still looking at 7 or 8% inflation for the year. So we have to kind of go into next year to really get some relief down towards maybe 6 or 5 or 4, and which is what the tips market, of course, are predicting. So I think the conversation is not, will we get inflation relief? I think the Fed sees through that. That's why the Fed's going to keep going, as Kevin mentioned. Whether it's 50 or 75 remains to be seen. I don't think it really matters. What matters is, where is the Fed going to peak and when? And it looks like it's going to be 3.5 somewhere later this year, early next year. And then, of course, the market is expecting the Fed to then give back some of those rate hikes fairly quickly in the coming years. And the question is, will that be kind of a benign gift back to the markets like Greenspan did in 95 when he cut rates 75 basis points after raising them 300? Or will it be because we are in a bona fide recession by then and the Fed needs to cut? We don't know the answer yet. But for me, the big question is, the Fed has a dual mandate, right? Full employment, price stability. and its inflation target's 2% on the PCE, so that's about 2.5 on the CPI. If a year from now we are in an actual, NBER defined recession, and inflation's only 5 and proving to be somewhat sticky on the core side because of, we all know what's happening to rents, for instance, how is the Fed going to manage that dual mandate? Are they going to be able to exercise that Fed put the way that they have been since the financial crisis in 2008, or will they have to kind of remove that put or push it further out of the money because they just won't have the ammunition to cut the way they have in the past because inflation is not coming down fast enough? So it's not a conversation necessarily for today, but it is one for the coming months and quarters.
Look, I've seen a couple of models that all predict the same thing. One of the friends of our channel, Alf, he says the bond market is pricing the Fed to cut in 2023, shortly following a swift hiking cycle. So I think a lot of these indicators are saying, look, this is carrying on until 2023, and then the Fed's going to start cutting. Raoul, do you agree?
Look, I've got a very variant perception here. I think inflation goes negative in 18 months' time. I think the price of oil comes down to $60. I think everybody's a supply side analyst and nobody understands demand. I think the ISM, which is the driver of the business cycle, or the best kind of monthly indicator of the business cycle, I think it comes down to about 40.35. So that's a kind of negative 2% GDP print, which I think the markets will ignore for the reasons I said before, and the fact that the euro-dollar market is already pricing cuts for January. I do think that I think we're talking now at turning point in the cycle, right? And everybody just always looks at where we are today. Inflation's at 8.5%. How can you possibly think the Fed will cut? Well, the Fed have cut every single time in history since 1960 when the ISM has gone through 50. They've either cut or paused. They only paused once, which was 2016. Every single other time they've cut. So they talk a game, but growth leads inflation. I don't buy the structural inflation side of the story for this part of the down cycle. I can consider it for the next bull market and the next economic upcycle if we haven't built more supply in energy and some commodities such as copper. But copper's been screaming at you that inflation is not an issue. Every single commodity, from wheat to copper to aluminium to everything, is down 25 to 50%. It's only oil and gas for the reasons we know. And I think oil comes down to $60 anyway. Now, year on year, that's going to give you negative 50% oil price. So the headline CPI is almost impossible to be positive because of the year on year comps. So I think, so to sum it up, bigger, faster recession. I don't think it impacts markets. I think, kind of as Kevin and Jurrien think, I actually think markets are fine. I think the bond market does extremely well because it's utterly mispriced. It's the most mispriced of all the other assets versus the business cycle. So that's why I'm wearing my buy bonds, wear diamonds t-shirt. I don't disagree with Kevin that equities will do well. I just like the risk-adjusted return in bonds. I love bonds because they're easy ways to make money generally, because you only have to figure out two things.
And actually, we can pull the slide of the head and shoulders top on the 10-year. Yeah, that's a nice chart. Raoul and I were talking about that earlier.
Yeah. So that's the head and shoulders on the US rates. What is that? The 10-year rate? Yeah, the 10-year and is that the 10-year rate, right?
Yes.
So
10-year nominal, 10-year real.
So as I showed you, my chart. Okay, so my chart was showing that we're back above the head and shoulders because rates have gone slightly up. So you can see my chart just shows that we're just a little bit above the neckline over there.
Okay, I think trend lines and necklines can be tricky. Can be overrun on a short-term basis. I wouldn't say that would disqualify the story.
But to go to Ran, I think the most important point is, if I think of the asset allocation process, right? My view is weaker growth. My view is the Fed come into play, i.e. they stop somewhere set or op. I think the bond market rallies. What do you want to own? You want to own the furthest out duration thing you could possibly own, which is crypto, which is why crypto based exactly around the same time as the market starts picking up that the Fed were going to pivot. So this moment the euro-dollar market starts pricing in cuts, crypto bases. So that's how I think of the portfolio allocation. I love bonds. I think they'll do well. I don't want them for yield. I want them for price appreciation. But the real game in town is going to be crypto.
You want to go, or the real game in town is risk. Kev.
I want to weigh in on the bond discussion because it's a good one. And I think in terms of allocation and distribution of your own portfolio, I don't care who you are, there is a place for fixed income. Now, we run a pretty big fixed income desk here. We look at all credits, right from treasuries and govies all the way over to factoring for retailers. And the challenge we're having right now in pricing in risk is in a bond situation, if you get it wrong, you have to wait a decade to get your principal back. That's not a good outcome. And you could go shorter duration. But what's bothering me as a bond guy, that's how I started my career, is what BlackRock is doing right now. Instead of buying fixed income, and remember, they're trying to put to work billions every week, they're buying U.S. apartment buildings instead. They're reallocating away from an actual bond, a covenanted instrument, and they're buying fixed income based on distributions of rent.
Because they're after yield.
That's not a good sign. That's not a good sign.
I'm just after capital gains. You know, where are bonds in a year's time? Probably at 1%, okay, in terms of yield. So capital gain is my trade. For yield, forget about it. These guys have so many pension liabilities or hurdles that, as you say, they have to do that. And we'll come into the ETH yield later because it's super interesting for these guys as well. But you're dead right. I mean, bonds really have no value, even in a pension fund, because it'll never close the funding gap, ever, at 3%.
Yeah, they have to the average distribution from a pension is about 5.7% they have to send out every year. You can't get that from any form of fixed income without taking huge risk on leverage or duration. And so I think I get your capital gain play. You're making a call on interest rates. And I would tend to think you're going to be right in the next 24 months. But as an investor who's got to kind of put capital to work every day, I'm having a real hard time on fixed income here, because if my bogeys, call it 6%, and I'm only getting 300 basis points from a portfolio of fixed income, I'm offside 300 basis points on my mandate.
You only want to rent fixed income. You don't want to own it, if you know what I mean. It's like, it's fine for a trade. It's fine for a trade, but it's not something you want to marry because you're just going to lose money.
And there's an analogy to the 40s and 50s here, especially the 40s, where, I mean, the Fed is not doing yield curve control, at least not yet. Maybe it will at some point. But, you know, that once the inflation rate on a structural basis, let's say a 5-year CAGR of the CPI, crossed over the 10-year yield, you had a decade and a half of negative real returns. And, you know, if you hold a bond to maturity, as we all know, the yield on that bond is your return, right? If you hold it. So a 10-year at 2 3/4, that's going to be your nominal return. And if inflation is at 4, which is not a prediction, but then you have a negative return. So I'd rather even just buy like utility stocks, you know, which between the dividend of 3% and earnings growth or maybe some buybacks, you can get, you know, high single digit.
And when you went back to the 40s, as you and I have talked about several times, is there was a period where it traded sideways and then equities went up 900% because of negative real rates. I look at the trend of 5-year real rates since 2000, they're just trending lower. The average, if you draw a nice average line on it, is negative 1%. We got to plus 50 basis points and broke the economy. I mean, we're fucked. I mean, there's no way we can have positive real rates in this economy. So the reality is, I think negative 1% real rates, as you said, which is fantastic for equities, terrible for fixed income investors.
I think for crypto degens, I think bonds is a non-starter. I got to be really honest, and this channel is full of degens. So I think fixed income is probably the furthest away they want to be. It's either going to be Tesla stocks and meme stocks, or it's going to be crypto. Speaking of BlackRock allocating funds, they made 2 announcements this week. The first announcement is that they partnered up with Coinbase to bring crypto trading into their Aladdin system. And to make it easy to buy and store crypto. And then they made a second announcement that they've started a Bitcoin private trust, which allows their investors to invest directly into Bitcoin. So 2 announcements in the span of, I guess, a week. How big is this news around Aladdin and allowing their investment base to be deployed?
I think you missed a third announcement from BlackRock and Fidelity simultaneously. They each put $200 million of equity into Circle in the F round at a $9 billion valuation, less a discount they got, which I'm going to assume is 15%. That is huge. Remember, this is a very controversial asset class. Stablecoins are a shit show right now. And there you have the largest, most conservative, completely compliant institutions on earth putting $400 million. Now, I have to disclose, okay, I participated in that round. I saw that happening, so I'm in that round. I own a piece of Circle now on the F round beside Fidelity and BlackRock. And I did it because I saw them going into it. I would have never have done that without the endorsement of such compliant SEC regulated entities making a bet in the middle of a shitstorm on stablecoins. It's a turning point for crypto. That's what I think.
So the turning point is the three pieces of news put together, just to get it all right.
No, it's not just that. We're going to get regulation. Listen, we were supposed to get a policy just on stablecoins reviewed this month. They pushed it, and I'm talking about now on the Hill in Washington. They pushed it to September to consider it. You got to remember, there's Haggerty, there's Loomis, there's Toomey, and Toomey is going to retire in January. He wants to get one piece of policy done. He wants to get stablecoins regulated. And the policy they're putting forward, I've been spending a lot of my time in Washington on these bills. And I'm not the only guy doing this. And I'm totally transparent on my interests here. I want to get some kind of payment system for my global businesses when we're transferring cash. I want to use USDC between here and Geneva. We index. I have an indexing business. So we're constantly, every day, taking US dollars, ACHing it over to Zurich. They charge me a fortune for that. It takes 36 hours sometimes. Then they nip me on the FX trade when I go into Swiss francs and buy a Nestle or a Roche or whatever I'm buying to index it. And then they screw me again on the way out. I could completely eliminate that with a payment system. And everybody knows that. So there's a lot of utility. Second reason you got to be bullish here is this. Both sides are supporting this, Dems and Republicans, because it makes the dollar, if you get a U.S. stablecoin policy in place, it makes it the default payment system of the earth. Not the Swiss franc, not the euro, not the British pound, not the Chinese yuan, the U.S. dollar. So this is coming back to the House on the floor in September, and it may be the first piece of legislation that provides the launch ramp for more crypto policy. Now, you know there's a war going on between the SEC and the other regulators, a turf war on crypto, but you can't deny crypto is here to stay. In fact, I believe in the next 10 years, it'll be the 12th sector, the S&P. And I'm trying to make bets all through the continuum of projects. I own everything. I have 32 positions. I don't know which ones are going to work. I don't need them all to work. I just need a few. Huge position in Ethereum, huge in Bitcoin, Solana, Polygon, Helium, Pollen, the new one I just took on. There's all kinds of projects. And the thinking for me is this. You go teach a class of MIT graduates in engineering right now. I do guest lecturing there. 1/3 of the class are entrepreneurial. Where do they want to go? They have no interest in working in any of the 11 sectors of the economy. They want to work on the blockchain. They want to be in crypto. You can't pour that much intellectual capital into something and not have great outcomes one day. It's like being at the beginning of the internet. And I'm talking about the smartest, brightest men and women from around the world saying, screw everything else. I want to work on crypto.
Yeah. I would just add to what Kevin just said. You know, Fidelity, which I proudly represent. We've been in Bitcoin since 2014, so not a lot of people appreciate as a legacy financial services firm how long we have been involved. And you know, I was part of a delegation in Austin, Texas, in June for the consensus. And we had the regulators, we had the senators, you know, who we all know who are proponents of the space. And we had the chair of the CFTC there. And there was a lot of consensus, for lack of a better word, that at least regulating the stables is kind of the ultimate no-brainer. You don't even have to worry about whether it's a security or commodity. So that was pretty low-hanging fruit, and obviously it's good that it's hopefully going to happen, because it will legitimize the space, and it will help the institutional adoption. It will make institutions feel a little bit more comfortable that there are actually some guardrails involved, even though it's only the stable side and not the actual space itself. But at least it'll be a start.
Well, if there's regulation in stables and more people are comfortable buying stables, those stables can much more easily filter into things like Bitcoin and Ethereum. I think one of the biggest problems is we don't have enough stables in the crypto economy to actually drive the prices up. And if you regulate stables and you get this pooling stables, even though initially it's just used as a settlement, like Kev says, it actually does change things, because now you've got a whole lot more money being available to be invested in crypto assets. So I think that's huge. I didn't actually look at that. I actually just looked at the Bitcoin, at the BlackRock Aladdin news and the BlackRock Trust news. You've actually showed me the third piece of news.
everybody in the entire financial world is short upside calls on crypto, right? What that means is the more the price goes up, the more regulation changes, the more they have to get involved. I've seen a setup once like this before, which was the launch of the GSCI Commodities Index back in the late 90s. And basically nobody had commodities in their portfolio. Everybody went to about 5 to 10% weighting, right? The amount of buying was in the hundreds of billions of dollars. The magnitude of what needs to happen here and the fact that everybody's short means that over time, they all get flushed in. And all the conversations I have are with the biggest financial institutions on earth, whether it's the sovereign wealth funds, the biggest asset management firms, the biggest family offices, the biggest pension funds. I mean, it's on everybody's radar screen. And incrementally, every bit of news you get that's positive on regulation, or somebody like BlackRock showing the way, or somebody like Texas Teachers showing the way, or somebody like Fidelity showing the way, makes people braver and braver. You know, when you look at what Goldman is doing, JP Morgan's doing, I mean, you're giving confidence to more people. All they need is a bit of price action and they'll be in.
And I would just add, if we can pull up the chart here, you know, this all helps the adoption curve, right? So if stable coins are regulated and are deemed safe, and we don't have the headlines about stables that we had, you know, not too long ago, and the space gets legitimized, then I think maybe investors will have more confidence that the network effect, you know, the adoption curve of Bitcoin, which has followed, as you can see here, you know, a number of historical S-curves, whether it's internet usage or mobile phones or what have you. I think as the space becomes legitimized and gains more scale, I think more and more investors might start to feel comfortable that the promise of this expanding adoption curve actually can be fulfilled. And you can see here, right? So these are a couple of different models that I have. One is the S curve, or a modified stock to flow curve, and the other ones are two demand models. You know, we're below all of them, and of course we had a big crypto winter, a lot of deleveraging. You know, it's kind of par for the course. I think the space is pretty washed out, as Raoul said. You know, everybody basically is either short or at least not long, and so I do think there's a lot of potential here. But as you know, after yet another crypto winter, if the space feels safer, if the water feels safer to go back into, more and more people will start looking at the promise of this adoption curve. And as Kevin said, you know, the dollar stables, the dollar actually getting cemented as the reserve currency, which of course is the opposite of what a lot of Bitcoin maximalists have been saying. But I agree, and I think it's absolutely correct. I think it will help, you know, fulfill the promise of this expanding.
It's kind of weird. I don't even look at the Bitcoin price anymore. It's ETH.
Me too.
And the moment that the merge happens,
it's a good segue, but you've got to remember, we've been talking about the merge for 5 years. And
okay.
So, you know, let me be the skeptic. This is my largest position right now. ETH has moved up and put it at the top of the heap of my 32 positions. I'm a skeptic till I see it happen, because you got to think about who loses in the merge. You know, and if you're a miner right now, you're not loving this merge idea. And there's a lot of capital tied up in that. And so when it happens, I'll believe it. But we have seen this thing punted down the road 5 times. So what makes you so confident it's going to happen?
Okay, so let's quickly talk about that. So yesterday they moved on to the last of the testnets, which is called the Gurley testnet. That was a successful move. So pretty much they've gone on all the testnets and everything's worked, which kind of means that in practice, in theory, everything works. Now, I agree with you that the miners have got a lot to lose. And that's why the miners are now forming this coalition to actually fork Ethereum. So what you're going to get is you're going to get an ETH proof of work and you're going to get an ETH proof of stake chain. And that's currently what's happening. So,
is that a good thing?
Okay, so I'm not sure that that's a good thing, but what we know for sure, let me just give you the facts. So right now, there's a derivative of the proof of work Ethereum, which is trading at 3.8% of the value of the proof of stake Ethereum. So what people are forecasting is that the chain will split. You'll get a proof of work Ethereum and a proof of stake Ethereum, and 96% of the value will lie in the proof of stake Ethereum, and 3.8% of the value will lie in the proof of stake Ethereum. Now, Circle, USDC, USDT, and a whole lot of others have all said that they're going to support the proof of stake chain, because you can't support both, because you can't have your coins on both. but yet there is 4% value in the proof of work chain. Earlier this week, that was 8%. So the value of the proof of work chain is coming down. Look, right now, the futures are pricing the merge to actually happen and actually happen on time, which is quite ironic because anyone who's been around for any amount of time always knows that Ethereum is delayed on things. But I mean, these are the facts right now. This is what the market's talking about right now. Raoul, what do you think?
Some of this is causing havoc in capital markets around data centers. I want to point something out here that I think we haven't touched on. And again, I'm tracking this from indexers. So if one of my core businesses is to index for sovereign wealth, 70% of capital that's invested around the world, and it may be when we measure it again, 75% is in sovereign wealth and pension. And so I can report to you faithfully that they own no crypto, zero. And so for all the excitement, and the reason they don't is they don't have any infrastructure to be compliant. It's not just that they're not allowed to because it's not regulated. They have no infrastructure to market. And so that their compliance departments can monitor whether they're over-levered, or they have whatever their mandates are. Let's say you're maxed out at a name at 5%. They don't have any infrastructure to make that work like a stock or a bond. They're working on that. So is FTX, so is Binance. All the major trading platforms are trying to provide that infrastructure. But as it stands right now, last year, up to just before the correction, they were using public Bitcoin miners in the US as a proxy to own Bitcoin because it traded in direct correlation, and I know that because I indexed for them. And so I'll never forget this. This is crazy. We were indexing, other indexes are doing the same thing. The indexing business is about making 3 basis points. If you're an oil-rich country and you're bringing in $500 million US a day, the only place you can put it is the S&P 500. You don't move the market with that. And so at the end of the day, they'd say, okay, index to S&P, X oil, X airlines, because most of those countries own their own airlines. So, and they don't want any oil because they got plenty of oil. So when it came to Bitcoin, they said, look, we want 50 basis points. Come up with an index that is a proxy to the risk on Bitcoin. Bitcoin's the only one they care about. And so everybody designed these indexes. Now, the morning the SEC memo came out calling for auditors to sign the carbon credit claims. In other words, if you're a S&P 500 company and you say, look, I'm carbon neutral because I buy carbon offsets, well, the SEC wants you to sign that because everybody knows carbon offsets are bullshit. And if you're a polluter and you say you own an acre of the Amazon, that's BS. Now, why would that matter to Bitcoin? Here's what happened. Within minutes, everybody that was an indexer got a phone call from Sovereign Wealth saying, dump every public mining stock in Bitcoin you've got because none of them are going to be able to pass this audit. It's never going to work. And they are agnostic to price. We were selling into declines of 20% an hour. And I didn't want to do that, but we did it. You go look at a chart of a Marathon or a Hut 8 or a Hive. That was the indexers dumping those stocks. And now there's no way they're going to give a proxy for Bitcoin because half the world won't buy them because they're polluters. They're dirty miners. So now you have to do mining with hydro or you have to do mining with nuclear power. And the biggest investors in those facilities, like the one in Norway, there's a company called BitZero, private, is the UAE. Same with North Dakota. The Burgum announcement last week, that old nuclear facility that's been on the market since 1975 just got sold to BitZero to turn it into a giant clean data center. So new money moving into it, which I say is bullish for Bitcoin, because at the end of the day, the highest return when you're stabilizing a giant $600 million data center before you sell it to Microsoft is you rent it to Bitcoin miners. So you've got these massive facilities being built. Another indice, which I think is a foreshadow of demand, because when we get policy on Bitcoin and it gets indexed to 1% in a $900 billion fund, that's really good towards getting that price up to 100,000. That's the only way you're going to get it, because if there's volatility, you've always got the underlying bid from the sovereign wealth fund. You have to be bullish if you believe in regulation. That's my point.
Let's talk about the ETH, because I think, Raoul, you touched on the ETH merge. Huge implications for me. If I think about it logically, if the merge is successful, and look, right now, all the testnets have been successful, you've now got yourself the opposite of Bitcoin. You've got yourself an ESG-friendly asset because it's now moved from proof of work to proof of stake. You've got an asset that is now truly deflationary because, remember, rewards are cut by 99%, and there's EIP 1559, which actually burns Ethereum. So net, you are decreasing on your Ethereum. And you've got a high-yielding asset, which Bitcoin is not. So remember, institutions who are looking for yield can now go into Ethereum and get themselves real yield. And when I say real yield, it's the reward for validating on the network. It's not. It's a proof of stake validator reward. So you've got yourself, dare I say, a better asset for institutional investing.
So look, all of those points are correct. And no,
they get policy. Will they get somebody in Washington to say that's okay if you're a public pension plan? They need the policy on crypto in the sense, even if they only regulate Bitcoin and Ethereum. And so many people in the crypto world are against regulation, but I say that's false. If you get regulation, you get more capital. You've made a great case right there for why we want policy on Ethereum.
And I totally agree. The point being is the big pools of capital, whether it's people like Apollo or Blackstone or BlackRock or everybody, sees yield, right? They didn't own gold because it didn't have a yield, and it's difficult for them because they have the hurdle rate we talked about before for so many of their clients. But it's a bigger story than that. It's much bigger than a supply and demand story. What we're actually creating is the benchmark interest rate for Web3. So this is the big daddy of which all risk will get priced against. Everything in the world is Treasuries plus or LIBOR plus, everything. Sure, in Europe, Italian spreads are Bunds plus. So we have an ability to now price risk. So how does this work? If I look at the Solana staking yield, which is higher than the expected ETH yield, once you adjust it for the volatility of the underlying currency, much as you would do with emerging market bonds, well, they match. So you've got pricing relativity. You can understand what's mispriced, what's not priced, where the risk actually lies. That creates an explosion in DeFi. Because once you have a proper yield curve, that you have and again, I'm going to use the term because people don't fucking understand it, is risk-free rate. The risk-free rate is the fact that the ETH yield will be guaranteed. What won't be guaranteed is the value of ETH. It's the same with the US dollar. If you buy US dollar bonds and you're a non-US investor, the bond yield will go, the currency will go up and down against you or in your favor. So this whole setup is much larger than anybody expects. If we want to see where DeFi goes, this is the big unlock. It's also the big unlock for institutions. It's the big unlock for pension funds, as long as Kevin said, regulation comes as well. This is a much larger impact than anything that's happened in this space since the launch of stablecoins and the launch of Ethereum. That's how big it is to me. And it's not an overnight, you need to buy it now, it's going to go up immediately. I'm talking about structurally, you know, as Kevin said, as regulation eases, as people understand and have clarity, this becomes a monstrous asset for this entire new financial world.
Yeah. And if I could just add to that, if we can pull up the slide, you know, you look at valuation of ETH versus Bitcoin, you look at their S curves, and here I show the two S curves. You know, ETH basically crushes Bitcoin's, you know, adoption curve, and we all know why. It's more, you know, more programmable, but the valuation of Bitcoin is much higher. Like people are paying much more on a price to network basis for Bitcoin than they are for ETH, and I think part of the reason for that is, of course, the built-in scarcity and the decentralization, et cetera. But if some of the headline risk for ETH starts to dissipate, based on the conversation we're having right now, and investors start to, you know, reward Ethereum more for its scalability, then, you know, you have potentially a lot of upside. I think also for Bitcoin, but maybe more for Ethereum.
Yeah, and they're very different assets as well.
Yeah.
Do you see Ethereum flipping Bitcoin at some point? And I mean, when I say at some point,
without question.
I'm having a hard time with that, because when I talk to sovereign wealth, I don't care if it's Norway or the UAE or Saudi, they want Bitcoin. They have not got to the analysis that we've just gone through. They want the proxy of Bitcoin, and they want that volatility. I think for financial services, I agree that ETH, the gas fees are a joke. That's the problem. This will help solve for it. But if that becomes the default platform for other digital assets, that will help. But in the immediate term, the demand is for 1% to 3% of a portfolio, a standard. These sovereign wealth portfolios look like this: no more than 20% in any one sector, no more than 5% in any one name. So you're never going to find, Boeing or Bank of America more than 5% in a $900 billion fund. All the indexers know that. It's a really standard format. When you ask them, if you could buy a digital asset, which one would it be and what allocation? It's about 50 basis points on the low end, up to 300 basis points on the high end. And 99% of the time they say Bitcoin. That's all they know. And so it's going to take a while for that demand to come. And I think it would be number two. And they certainly like USDC and they love Solana and Polygon. You go down the list based on market cap. I get it. But right now, if we had policy on Bitcoin, I swear to you, the price would be $60,000 in 2 weeks.
And Kevin, if you index like Bitwise is doing a basket of crypto, let's assume they're not ready, as you say, but when they come in, they're going to want that kind of product, right? Because then that gives them, because we don't know, like you, we've all got a bunch of positions. We don't know what's actually going to win here or not. We can all have opinions, but it means nothing until we find out. But surely there's going to be big demand for index product in this space at some point.
Except the really big guys do their own index. They basically, they rent indexers like me, and they say, design this. Because most often those commercial products are doing 20 basis points to 45 basis points. They're never going to pay that. You're lucky to get 2 basis points out of them. And so that you do the work, and then they have a custodial. And that's where it gets interesting, because Bitcoin trades 24 hours a day, and all crypto does. And that's a new beast for the compliance departments of these giant funds. But the demand, the reason I'm long now with all this volatility, we have 20% of our operating company's assets, that's our max, in crypto across 32 positions. I'm about to add Pollen, which is a decentralized telco. We've done a lot of research on. We like it. We think there's a lot of interest there, but that's a really fringe project. The point is, I'm trying to get ahead of the day, because we're all agreeing that at some point we're going to get policy. I need to be long before that happens, because that's the reward you're going to get, is when that stuff gets indexed. And whoever gets to index it, the demand for at least Bitcoin and Ethereum out of the beginning is insatiable. It is insatiable at the sovereign and pension level. As for all the skeptics that are, don't like crypto, they're going to watch that asset move into an indexed price, which I think is $60,000.
Kevin, quick question for you on this. What regulation do they need? Do they need UAE regulation? Because Dubai's doing a pretty good job. Saudi's doing a pretty good job now. Or do they need global regulation? What regulation framework does Norway need, in general?
So the ADGM, which is let's talk about the UAE, because this is a fantastic question. Last month, I got my UAE citizenship. And I did that to go through the scrutiny of the background checking, so I could act as an operator and an indexer in that market and a financial services entity. And so that was a lot of work, and it was worth it. I've been trying for 3 years, and they don't grant many of them. So when you look at UAE, it's Abu Dhabi is 95% of the capital. So you have to operate out of there. It's called the ADGM. And they set policy on crypto. They grant licenses for exchanges. But here's the thing that they won't do. They will not, let's call it, jump hop the SEC. They will not do this and make it a standard for their own sovereign wealth before the SEC gets a chance to move. And the reason for that is really political in nature. The largest manager of sovereign wealth in the world is BlackRock. That's Larry Fink. He's not going to do this until he gets the go-ahead from the SEC. And so they're not going to ever mess around with their largest manager. And Larry's telling them, and I'm speculating this, okay? I don't know this for certainty, but he's saying, let's just wait. Because when we get the SEC to approve this, whatever approval it is, and we'll build you the infrastructure so you can mark to market it so that you're staying compliant in your mandates, then they're going to put on their waiting. And so I think this thing is going to happen after the midterms, after we get the policy on stable. They're going to start looking at Bitcoin. I don't know which regulator is going to get to regulate it, because there's a turf war going on. But if you're a speculator and an investor, like the three of us are looking at this, and you, both of you guys are so down the rabbit hole as I am, I need to be there ahead of this decision, because it'll happen quickly. And you won't be able to put on your position, and the market will move against you so fast. I am extremely optimistic on Bitcoin and Ethereum over the next, call it 24 months. And the way you should measure your enthusiasm, or curb it maybe, is they struck down the Bitcoin ETF just weeks ago, even though the Canadians have one. And I believe that the OSC, which regulates the Canadian ETF of Ethereum, which is mark to market real Bitcoin each day, okay, they basically are the petri dish for the SEC. They work so close together. In Canada, for example, you know how Coinbase is at war with the regulator right now. There's a company called WonderFi with 700,000 accounts, 720,000 accounts regulated by the OSC. Canadians are allowed to trade 14 different tokens legitimately regulated with the authorities being tax reported. They're so advanced, and we haven't even got there yet stateside. And so I think they're using Canada. UAE is talking to the OSC. Why do I know that? Because I own that company, and I showed them the order from the OSC. And I went to Abu Dhabi and sat down with the ADGM and said, why can't we use the Canadian order and build it here? And they are thinking about it, but I know they're hesitating because the FAB bank is the largest bank in the UAE. They want the central bank to regulate. I mean, we're getting down the rabbit hole here, but
final question then, Kevin. The question everyone will want to know: when do you think? Best guess, you've got no idea. Best guess, we get the clarity, SEC, CFTC, and yes, no.
By second quarter 2023, after the midterms, if the House flips. You get the Republicans on this, they're way more pro-crypto. Most of the bill initiatives are coming out of red states, and I don't want to be political. But if you get the House flipping, they'll put that on the agenda. But don't expect every token to be regulated. They're going to focus on the market capitalization and say, here's policy on Bitcoin, here's policy on ETH. I think you want to be long after November 8th. I mean, everybody's got to speculate on what to do here, but you've seen the winter at the bottoms. We're slowly crawling out of the toilet here. Your portfolios are up, 20, in some cases 23%. I mean, our 20% position went down to 15.2. That's pain. That's pain, my friends. And our desk was saying, what do we do? What do we do? I said, we do nothing. Where we know we're in this volatile asset class, and we're going to have to wait for some policy. That's why whenever I talk about crypto now, I'm pro-regulation. I want the sovereigns backing me up with a bid every night.
Yeah. And if I could just add a couple of quick things. If we pull up the slide, remember that as Raoul said, people think about price, but it's really about valuation, right? So price to network ratio on Bitcoin is back to 2014 levels, right? So that's because the network keeps growing. So, the question was earlier about ETH versus Bitcoin flipping. I don't really care. I see them both as different players on the same team. I own them both. I think they're in different places on a portfolio, right? ETH is maybe more on the VC side of a growth portfolio. I see Bitcoin more as a competitor on the fixed income side in a world of negative real rates. So I don't think they have to compete with each other. It's not like we're putting on a pair straight. I mean, maybe some people are, but I'm certainly not.
Okay, so I mean, I guess clear that that's not going to happen, but it is going to bring in much more money into the ecosystem because of the reasons that I said that. I mean, I think you got to go into this merge long ETH. Raoul, what do you think?
Well, I'm max long, and I have been, and it has not changed, and I just keep adding. So that's ETH, Bitcoin, a few other tokens. I've got this fund-of-fund business, so invested in that across digital asset hedge funds to capture some of the alpha of the space. Look, it's getting a little bit overbought. I think, if we're getting to trading tactics, whether we get a pullback soon or not, I think we rally into the ETH merge. I think it definitely happens. Whether it happens on the 15th, there's a story coming out that it might come out early, the 19th. It gets out of the way. As Kevin said, that removes some of the uncertainty of the space. Maybe that doesn't happen. There's still a probability that something goes wrong. Then I think it's buy the rumor, sell the fact. It's pretty standard market operation. You buy that pullback with both hands. For what Kevin's saying, for what I'm saying about rates, for what Jurrien's saying about network growth, any big pullback you get from here, there's going to be a bunch of people saying, wait for the new lows. I just don't think you wait for new lows. You just use that opportunity.
And if I can pull up Raoul's favorite chart, you can kind of see the point there.
What are we looking at?
I'll say compelling. I'm not a big chartist, but you have some very interesting data here. There's no question about it, particularly in the crypto space. I haven't seen such charts in crypto ever. So this is good stuff.
Thank you.
As we like to bring you good stuff. Guys, we do have like 2 more minutes, and I do want to ask you a question, and it's not a bullish question, and that's around the US sanctioning an open source protocol in Tornado Cash this week. Admittedly, as per Chainalysis, about 10% of the activity of this protocol is for hacks and thefts, and 90% of it is actually for legitimate privacy transactions. And
I say this is a good thing for the market. Scraping the patina off the bad actors, the idiot managers, the over-leveraged, unsophisticated traders. It's important to do that because it makes the rest of this ecosphere very, very stable. And the more you get, I love it when these guys using leverage who've never done this before, I'm assuming because they blew their brains out the old-fashioned way, they're eliminated from the market. The lawyers will pick over the carcasses in litigation. That's okay. But these players are out of the market, and that's important. The DNA of the remaining survivors gets better. That's my whole point. So, you know, these crazy, the Luna story, this story, get rid of all that crap, because I can tell you right now, algorithmic-based stablecoins are not going to be popular in the market. You can't wipe out $50-60 billion and get everybody back on board. That's not easy to do. So I think that's a good thing. I'm pro on this thing, and I want to scrape out the idiot management. More scraping of idiot managers. It's better for those managers that remain and survive.
Yeah, and I would just add, you know, as institutional adoption grows and more investors have a handle on this network effect, this adoption curve, which provides kind of an anchor in terms of the fundamental valuation. Every time Bitcoin survives a winter and you get all this deleveraging and you've got these bodies washing up, it really only solidifies Bitcoin's value proposition, as Kevin basically just said.
And my view on the Tornado Cash thing is, I've been saying for a long time, there needs to be a grand compromise between the regulators and the market participants. Gensler is one end. He wants to kill you, take all your money, put you in prison, and then shoot you. The other side is the libertarians from the Bitcoin community who want nobody to ever touch them in any way, in anything they do, right? Those two people have to meet in the middle. And what there is a compromise. And the compromise to reach regulation is stuff like Tornado Cash, whether you agree with it or not, is part of that compromise. They say, we want a bit more control here. We want control over stablecoins here. You can do what you want with ETH and Bitcoin over there. And some way we reach something. So this is not going to be the only sacrifice in the game. And we'll fight it and scream about it. Maybe it goes through courts and they can't deem that code can be restricted in this way. But what they're trying to do is draw the lines. And we're all trying to draw the line to the other side. Somewhere we'll reach a reasonable enough compromise that, as Kevin says, allows everybody to operate.
So it's a sacrificial lamb, basically. You're saying that Tornado Cash is the sacrificial lamb. We have to start a Tornado Cash that the rest of the ecosystem can live in peace.
And there'll be other ones too. There'll be stuff in DeFi where they'll be saying, well, you don't know the KYC, right? They haven't done that one yet. They will do that. One of these DeFi protocols is really difficult because they're all DAOs. So they have to figure out how to do this, but somebody's going to get prosecuted there because they just want to make that statement is this good, that bad, and we're going to have to kind of find that agreement. Whether that goes through the courts or not, I don't know.
One of the developers of Tornado Cash, which is a decentralized protocol, was actually arrested today in Holland. The Dutch authorities actually arrested him for developing this thing. So this is getting quite...
If you can take every single Russian billionaire's wealth without any due process in any legal court in anywhere in the world, they don't really care about your Tornado Cash protocol.
Don't you think at the end of the day that it's okay to arrest that guy? Why? He's messing with the primal forces of regulation. And maybe he feels he's a crypto cowboy, but he just got a whole bunch of arrows in his back. And if we have to sacrifice him, that's okay, because we want to have some stability in that institutional capital. That's what we've been saying all hour. And I think we're getting to that stage now. Maybe we're in the third, fourth inning towards that. But I'm tired of this crypto cowboy crap. I want to get involved in a regulated place where we can bring billions of dollars to work. I don't need to be a crypto cowboy, and I don't want to be one because I work in the regulated world. I'm tired of that narrative. When you go to Bitcoin 2022 last year, and certainly 2023, the first day they had to open up the first Wednesday just for institutional interest, even though none of them owned any Bitcoin. They had 1,500 institutions at the keynote there. I mean, it was unbelievable, the interest, but they're not going to touch it while, the crypto cowboys are riding the fence. We got to get rid of this crap.
All right, guys, listen, it's been absolutely amazing. I know we're out of time. Thank you. Wow, I love Friday Banters. I love this one. Kev, Jurrien, Raoul, thank you so much. Much love from the Banter fam.
Thank you, guys.
Great to see everybody again.
And Banter fam, while you are here, Kev, thank you so much. I do have a whole lot of announcements for you, so don't go anywhere. First of all, I need to announce, let me thank the sponsors again. So remember, this is brought to you by NordVPN. They are the crypto VPN. You need to have a VPN if you're going to be surfing crypto. It hides your IP address and it protects you from hackers, and it hides your identity. So you're actually surfing anonymously, so exchanges don't know where you're at, etc. Also, today we're going to give away, the BYBIT competition has actually started now. So let's look at the BYBIT competition. There are right now, 1,606 participants. And we have a scoreboard, and the scoreboard right now, the winner is up 34.3%. Now, it goes on for 3 more weeks. And as I said, I'm going to sponsor 50 people to play. So if you're part of the 1,606 people that have signed up, you may be someone who gets $250 from me to play with my money so that you guys can win the trading competition. And that's what we're going to do in a couple of seconds. Remember, if you're not subscribed yet, all you do is you go to the link, the description link. Let me just quickly show you guys where it is. So you go to the show. Let me quickly get it for you, because I know there's some people that don't know where it is. Wow, what a banter. Tell me in the comments what you thought of the banter. I thought it was one of the best banters we've ever had. Mr. Wonderful was so wonderful. Raoul was so full of alpha. Jurrien and his charts were absolutely blew me away. I mean, people are saying I look stoned. I'm not stoned. I'm just very tired. I've slept like 2 hours a night here in Korea. I haven't eaten an edible. I can see you guys have said that in the chat. I'm just very tired. But here I am bringing you crypto love and crypto wisdom. All right, so here is the referral link. You click on this referral link over here, and you open an account. You put $250 into your account, and then we start playing. The game is on. It's on for 3 weeks. It doesn't matter how much money you're playing with. It matters that you're making money. I've put $10,000 into my account. You can see I haven't started trading yet. Here is my account. I've got $10,000 in the account, and I'm going to start trading straight after the show. I'm going to be posting all my trades live. Okay. All right. Now, I promised that I'd fund 50 people who've signed up. I'm going to fund 10 of you today, and the rest of you I'm going to fund over the next couple of weeks. So let's go through quickly and find the first 10 people that we can fund in this competition. Okay, hold on. Okay, here we go. We have the list. This is a list of all 1,000, or early on before the show, we pulled out about 1,000 people who had signed up. And today I'm going to take from 150 to 159. I'm going to put $250 into your account so that you trade my money. Okay, so you guys are all going to get $250 into your account. You're going to trade my money. If you make profits, you keep the profits. If you make losses, you don't lose, but you give me back the $250 afterwards. That's basically how it works. You guys are all going to get $250 into your account. Remember, it's not too late. It's not too late. If you want $250 put into your account, you want to trade with my money, and you want to win this trading competition where you can win $100,000. And yes, we're going to give away $100,000 over 2 weeks. It's so simple. Just go and sign up today. Let's get this number up to 2,500 people. Remember, if you're in the United States, you never heard it from me, but there's a thing called the VPN below, and a VPN lets anybody, but you never heard that from me, because you should never use a VPN to get onto an exchange where you're not allowed to do it, because that's just not allowed. Also, remember, GALA Games is doing something absolutely amazing. They're moving into films, and they are allowing people to be film node operators. Okay, it's huge. So I'm going to show you this again. All right, so look how cool this is. So we know now that GALA Games is getting into NFT films. So remember, it's NFT music, NFT gaming, and now it's NFT films. If you want to run a GALA game node, which is amazing, it means that you're going to make money every time these things are downloaded, etc. Go and check this out, film.gala.com/nodes. Go and check it out. It's absolutely amazing. I think it's the future of film. GALA Games is bringing it, but they also sponsored the show. Big love to you guys. Big thank you to NordVPN. Big thank you to the best community in the world. Big thank you to Raoul Pal, to Jurrien, and to Kevin O'Leary. I love you guys madly. If I get a chance, I'll come live at you tomorrow. If not, we're going to drop an amazing podcast that Sheldon and I did, which just shows the other side of us and what we do when we're not doing crypto. Have yourself an amazing weekend. Let's take one last look at the Bitcoin price. 23,981. Above the trend line. My thesis is we're carrying on going up. I'm going to play some trades to that effect. I'm going to broadcast my trades every single day on the show. I'll see you guys again tomorrow. If I don't see you guys again tomorrow, I'll see you guys again on Monday. Until then, have a good weekend. Much love and trade well, my friends.